there we go. All right, we're in business now. All right, here we go. Shake and bake. How's everybody doing this afternoon? Hopefully you guys are enjoying the day and just checking the market prices here real fast. They're kind of sinking a little bit, aren't they? But that's okay. We like to buy the dips. So you can't buy the dips if there aren't any. And so don't freak out when the market dips a little bit. That just gives you an opportunity to reinvest some of those dividends you're receiving back into the market. So this here is the S&P 500. And what I want to do today is, of course, we're going to go through and do a little day trading. And we're going to do that in the futures market. Now, remember, when we were in class, for those of you who attended my class, you know that we have both the stock market, which is out of New York, and we have the futures market, which is out of Chicago. All right, Chicago has different exchanges and they have different rules. Now, if you want to do a little day trading, meaning, of course, that you're going to get in and out of the market the same day, that's called day trading. All right, and if you get out within the same few minutes, that's called scalping. So we're going to do a little scalping, a little day trading. We're going to kind of do a little bit of both. We only have an hour until the market closes. So our strategies for day trading are a little bit limited here because day trades generally will try and be in the market a little bit longer than 1 hour. That's the whole idea of day trading. Trading throughout the day. You trade and get into the trend and you ride it throughout the day, but you're out before the market closes at the end of the day. You may not stay the entire day, but you might stay for several hours. That's day trading. Scalping, on the other hand, is where you get in and you just kind of take little pieces out of the market every couple minutes. You wait for a good setup. You come in here and you wait till it just gets perfect. Oh, it's just perfect. I can't believe it's so perfect. And boom, you take your little trigger. And if you don't immediately make money, then you just get out, take a little tiny loss and say, well, that didn't work. All right. So that's scalping. Day trading, stay in the market, try and get one of these long trends that last for several hours, right? We'll try and get some of these longer trends. Of course, that's a day market, so that's not going to be kind of the same thing, though. Same idea. We're going to come down here to a 1-minute chart. And you can see this 1-minute chart on the NASDAQ. NASDAQ, of course, being the top 100 stocks of the NASDAQ exchange. Now, you can trade the stock indexes out of Chicago. You can't trade individual stocks. You can't go in and trade Microsoft and Amazon and Netflix and Google and Tesla like you can over in the stock market in New York. But out of Chicago, we can trade the 4 big indexes. All right, we can trade the NASDAQ, the S&P 500, the Russell 2000, and the Dow 30. All right, so how many stocks are in the Dow 30? What color is George Washington's white horse? All right. So there's 30 in the Dow 30, right? There's 100 in the NASDAQ 100. There's 500 in the S&P 500. And there's Russell 2000 there's 2,000 stocks in the Russell 2000. All right. That's why they put the numbers in there. There's also a Russell 3000, but we don't trade that over here in the futures market. All right. And incidentally, the Russell 2000 is the bottom half of the Russell 3000. So if you have the Russell 1000, that's the top half. The Russell 2000 is the bottom 2,000 of the 3,000, and then the Russell 3,000 is all 3,000. Those are generally small cap stocks. All right. So keep that in mind. That's just a little side note, interesting thing to understand and know. But over here in the futures market, we have the NASDAQ, we have the Russell, we have the Dow, and we have the S&P 500. Now, why would I come over to the stock? Why would I go over to Chicago to do my day trading? There's a thing over in the New York exchanges called the pattern day trading rules. We don't have those in Chicago. Now remember, I come from Chicago. That's where most of my career has been, is working out of the Chicago exchanges. In fact, from 2000 to 2010, I spent a lot of time in Chicago back there working in the education center at the Chicago Board of Trade and the Mercantile Exchange. So that's kind of where, I taught there, but I oftentimes say that's where I got my education. I taught how to use computers to the traders back there. And so that's kind of where I learned to trade. I kind of learned to trade before that. That's why I was there, but they really taught me a lot more than I ever knew. You know how that goes. So anyway, the whole idea is that we want to day trade. And so we have pattern day trading rules over in New York. And so that makes it difficult for us to trade if we don't have an account of $25,000 or more. All right. If you have an account less than $25,000 and you start day trading out of the Chicago or out of the New York stock exchanges, they'll lock your account for 90 days. shut you right down and not let you trade. And that's not fun, having to sit around for 90 days waiting for an opportunity to take a trade. Ask me how I know. All right. So, what we do is we go over to the Chicago markets where there are no pattern day trading rules, and we can trade to our heart's content with a small account. Okay. So, if you're interested in doing a little day trading, the Chicago market's probably a little bit better place for you to go. Now, you are limited. You can't do Microsoft and Amazon, Netflix, but you can do the indexes, and they got lots of other fun things you can trade. You can trade the oh, this is my portfolios. Let's go look at the list. There we go. So you can trade copper and corn and British pound and Euro FX, natural gas and gold and silver and hogs and Japanese yen, crude oil and the heating oil and platinum and palladium and Russell and silver and soybeans, soybean meal, all kinds of fun things to trade. There's plenty of things to trade. So you're not at a loss for anything to trade. You just can't trade the individual stocks. All right. Just the indexes. But we like to trade the indexes because they move. And what you really want is you want a market when you're day trading and when you're scalping, you want a market that moves, right? It has some big moves in it because it's that volatility, those moves in the market that give you the opportunity to take a signal and get in and ride it like Paul Revere and make some money, right? Okay, so we're going to come in here and switch on back over to the stock market because I have both up. This is the futures market and this is the NASDAQ 100. So if we want to see the NASDAQ 100 over here in the stock market, that's called the QQQ. All right, so that's the QQQ right there. Now this is the daily chart and I got it. Let's blow it up so it looks kind of like what we had over in the stock market or in the futures market. Let me turn off this one here. We'll just leave this on. So that kind of looks the same, right? We come over here. This is the NASDAQ 100 on a 1 minute chart. That was a daily chart. So let's go pull this up to a 1 minute chart. And you're going to see that they're probably almost identical. All right. Yeah. See that? Almost identical. Now, of course, I got the magic blue smoke of trading turned on. So that's the blue light. So I'm going to turn on the little cheat codes, which are called the Heiken Ashi bars. And we're going to come in here. This is a 1 minute chart on the QQQ. I'm going to turn off all this stuff so it's not confusing us. All right, just keep it simple. So that is the QQQ or the NASDAQ on the stock market. This is the QQQ or the NASDAQ over in the futures market. A little bit different, but not exactly the same, but not exactly different either. Basically the same, 1 minute there, 1 minute here, basically the same market. All right. So we want to trade this one here because we don't get knocked out if we have anything less than $25,000 in our account. They don't lock our account down. So that's why we trade this one. Now, this is the futures market, so it's a little bit different. Okay. But, and also, since we're in the demo account, now in the real account, it doesn't do this, but in the demo account over in the stock market version is 20-minute delayed. All right. So this is 20 minutes ago. Whereas over here, this is actually live. So you're seeing a little bit of a difference here. This is the rally that you're seeing over there. See that? This is starting right here. That's this right here. So you know it's going to flush right here because this is live. All right. This is the NASDAQ 100 out of the futures market. We don't delay the data like they do in the stock market. Okay. So if you're yeah, you could cheat if you're only playing in the demo account, but it doesn't work in real money. So in real money, they're both live, so they're exactly the same. All right, so that's how this works. So what we want to do is we want to do a little scalping, a little day trading, possibly in the futures market. And I want to show you kind of a fun little strategy that you can play. And if you look at the little marquee that not that one. Let's see, this one here. If you look at the little marquee that we started out with, right? This is right here. What we said, oh my goodness sakes, what is going on with that? Grabbed the wrong one. Woo. Okay, so that's the little marquee we put up front, right? The little movie marquee. So it says day trade micro minis. So we're going to day trade the micro minis. What does that mean, the micro minis? For those of you who don't know, micro minis is the tiny ones, all right? Tiny ones, so we can trade with a very small account. We have minis and we have micros. We call them micros or micro minis, all right? But it's the micros. So in the micros, they're 10 times smaller than the minis. So this one here is a mini. So what does that mean, a mini versus a micro? Well, it means dollars, all right? So it means that if you would have got in on this arrow, let's say just from this peak to here to where it's currently trading, And you can take a short position, meaning you make money when the market goes down, just as easily as you can take a long position, which means you make money on the market when the market goes up. In the futures market, because you're going to offset it sometime in the future, right? That's why they call them the futures market. Then we're going to be able to take short positions. That's a little confusing for some people. So let me use my example going the other direction. How's that? We'll come in here and you can make money going from, let's just say from this bottom of this trend to the top of that trend right there. That was $650. You're like, what? That little move in the market on a 1-minute chart was $650? Yep, that's a lot of money. All right. And so this is the NASDAQ. So it's a big market, but that's $650. You say, well, how much did I have to invest to make that $650? You had to invest one contract, was the minimum amount size, right? So if we come over here to the key, you can see that that's an investment day margin of $1,847, not even $2,000. So with a $2,000 account, you could have bought right there and sold right there and made $650 on a $2,000 investment. I know, crazy, right? I mean, that's the leverage that you have over here in the futures market. Now, if we flip on over and we go over to the stock market version, that same run, which was right here, we go from here, let's just go from here to here. That's $78 for 100 shares. How much is 100 shares? If we come over here and look, we can see that 100 shares, the cost of 100 shares, the shares are at $619 per share. You did 100 of them, that was $61,000. So to make the same amount of money in the stock market, well, not even the same amount of money, you're making significantly less, right? I know it sounds too good to be true. It sounds absolutely asinine when I say it, but it would have taken you $61,000 to buy right here and sell right there to make $78 in the stock market. Yeah, $61,000 to make $78 to buy here and sell there in the stock market. And you'd had to have I was going to say, you had to have at least $25,000 to make that trade, but you'd have to make that trade $61,000. If you would have wanted to make the same amount of money, you're going to have to do the math to figure that out. But we can do it. Well, I'll do it here in a second just for kicks and variety. But if we come back over here to the futures market again, let me show you. Day margin, $1,847. So less than $2,000 investment. Buy here, sell here, $650. See the difference? See why we want to day trade over here and not over there? It makes sense, right? Kind of makes sense. You're like, you're kidding me, Lan. You mean I can put $2,000 in here, buy here, sell there, make $650? If I was to make that exact same trade over in the stock market, I would put in $61,980, buy here, sell there, and only make $78? That is true. That is correct. That's why we trade in Chicago for day trading. All right. Okay. Now, coming back over to the Chicago market, that's this one here. That is going to be scary for some people. Why? Because you're going to have to take a small risk to get into the market. All right. And if the market doesn't go the direction you think it's going to go, well, before you get out, you might lose quite a bit of money. $50, $60, $80, $100, right? You know, ooh, I don't want to lose $100. No, nobody does. But if you're going to trade this particular market, that's how big the market is. But it goes fast. If you make the money, it makes you a lot of money too. So let's say we're going to say, I'll take a short position here. We're going to put our stop in right here. If we get stopped out, we're going to take a difference, a loss. Now, again, we're trying to make money on the downside. So we just took a loss, all right? Because we thought, okay, the market's going to go down, and then it didn't. So we put a stop in there to get us out in case we were wrong, and we got stopped out. And that was $100 loss. Just like that. Boom. We lost $100. But if we do it again and the market goes down, we're going to go in there and put that in there, put our stop back in there again, just in case. And if the market drops, then we'd make money that fast too. That's the other side of this, right? The other side of this is if the market goes down and it goes in your favor and you do it right, you make a lot of money really fast. Of course, you're going to take a couple of hits along the way, maybe if it doesn't go in the direction that you think it's going to go, right? So now we're down $200. Just that fast, we're down $200. So that's why I said, let's go and do what we call the micro minis. All right. So we're going to go do the micro minis. They're 10 times smaller. So you might say, well, once I get in, I want to be in the mini. I want to be in the mini. But once I get in, I want to be in the micro mini. It doesn't work that way, right? So now it's going up. You wish you would have been in long. So you go buy and you see if you can capture that thing on the rise, right? And now you're going to put your little stop in there where you're going to lose money if you're wrong. And if it keeps going, well, then you make money, right? So we're making money. We're making money. How much we want to make? We can put a limit order up here and take our profits. And we lost 200. So we're going to just say if we make 200, actually, I'm going to have a little calculator turned on here. Watch this little trick. Add OCO. And I'm going to take that little calculator and it'll tell me when I make 200. So now I'm going to put 200 in there just like that. It has to go all the way up there to make 200. So if it'll go up there and touch that, I'll get my $200 back. See that? Okay, get up there. Giddy up. And I'm going to get rid of this one because I have too many stops in here now. I'm going to bring this one up. All right, come on. Get up there. Get up there. Get up there. A little more. There we go. See, now I got my $200 back. Now we're back at, see, so losing $200, not a lot of money when you can make $200 that fast, right? So that's the game you're playing. You're like, it's too big of a game for me, Len. Take me down smaller. Okay. Let's go smaller then. We're going to go in and we're going to go back over to the charts. Instead of going into the mini indexes, okay, we're going to go into the micro mini. So we're going to come down here. We're going to go down the list and we're just going to find the, this one is the NASDAQ. So we got a LMNOPQRSTUV. There they are right there. NASDAQ 100 micros, NASDAQ 100 minis. Now the mini is the one we're in now. You're like, that's too big. Take me down, something smaller. Okay, here's the micro. So now we go into the micro and we open that one up and we're going to pull down to a 1 minute chart and we're going to see the same thing, exact same chart. It's just a different risk reward ratio. All right, so we're going to zoom this in like we did before, turn on the Fibonacci bars because they're a lot nicer, funner to work with. I'm going to turn off all these indicators so that we can not be confused. And there you go. Same market, right? Same market. Now watch this. Now we're going to come in here and it's going to be 10 times smaller. Let's say we think it's going to turn out to fall now. So we'll go sell. And if it doesn't, we'll lose a little bit of money. But look at how much over here now that we're losing. $2, $3, not $30, not $40, $4, $5. Okay. So if we think that market's going to keep going up, well, we're losing money, but we're only losing $2.50. Think it's going to go down, but it goes up is what I'm saying. See, now it's starting to fall back a little bit. Now we're up $1, $3, $2.50. Oh, now it's going back up, but going back down, hanging out right there where we're in the market short. We're in the market short, which means we make money when the market goes down. And the way we do this is we close it out and we just close out the difference between you buy and sell, right? So we sold first. The only way you make money is to buy low, sell high. So we're going to buy low down here. We're going to sell high up there. We just sell high first, and then we buy back low later. We can do that. They let us do it. So right now, see, it says we're up $12. We're up $12, not $120, not $200. We're up $10. So 10 times smaller. Well, Len, what's your investment for that? Well, if we come into the key and look, the investment for that is basically 10 times smaller. So instead of having to have $2,000 or a little under $2,000 to trade, we have to have a little under $200 to trade. So $171 is all I needed to put that trade on. All right. Makes sense, doesn't it? That's all there is to it. Now you can, make it as more aggressive or as aggressive as you want, but it gives you the opportunity to trade a little bit different strategies when you're not risking quite so much money. All right. But of course, if you're going to do the scalping thing where you're just going to be in for a few minutes or a few seconds, even that market just pops up, makes you a couple $100, boom, you take it off, you're happy, you're done, you walk away. 2 minutes in the market, maybe 30 seconds in the market, and you make $100. That's a lot of money in a very short amount of time. You can be done and walk away. $100 a day keeps the doctor away, right? So now you can see now we're coming in here and it's going up. Now, this is a strategy that I don't recommend you do, but we're going to do it anyway because I wanted to show you a little strategy that that you can do here. So it's called dollar cost averaging. And the reason I want you to think about this is because you're 10 times smaller using this micro minis than you are the minis, 10 times smaller. So that means you can average your price up and still only be trading what would be equivalent to what would be considered one contract, but you can do it 10 times. So if you're wrong, rather than getting out and saying, okay, I took my loss, because you got commissions that you have to deal with, and commissions on the micro minis are you get commissions on every single contract. All right. So if it's 10 times smaller, that's 10 commissions versus one commission. But the difference is that, I mean, the commissions are smaller, but they're not 10 times smaller. That's just the way the ball bounces. All right. So what we can do is we can come in here and we can set up a little strategy where we can dollar cost average, and we can bring these markets up. If it comes up here, we'll take another position up higher. And this way we don't keep jumping in and jumping out of the market. All right. And this is going to be more of a day trading strategy. It's going to take you a while to play this strategy. And then it's going to keep building your position and pulling your average price up the trend until the market turns around and starts to fall. Once it turns around and starts to fall, well, now you're in the profit zone a little bit more easily, a little bit more quickly, without jumping in and out of the market so much and racking up a whole bunch of commissions that takes away all of your profits. All right. It's called dollar cost averaging. And it can be a very dangerous strategy, because if you just keep dollar cost averaging up, and the market never does go up, eventually the market can stay irrational longer than you can stay liquid, and you have to liquidate your position. And that's where in this strategy you take a loss. All right. So you have to say, okay, if I ever get up to 10 contracts, I have to realize I'm losing the same amount of money as I would be as if I was in that big market we just played with. And so then you have to have your stop really close. And then you just have to take your loss, your $100, your $200 loss. All right. And then you're going to have to make it up again trading the next day or something. All right. So keep that in mind, that this strategy can wipe you out because it's 10 times smaller, but you can get up to that 10 times bigger a lot faster by adding in more positions as you go. This is called, again, dollar cost averaging into a market. And we're going in with a very small position here, only one of the micro mini, but we're going to dollar cost average. So if we're wrong, you can be wrong, and then this will go up and just give you another position. Now you're in with 2 contracts, and the average price is going to be from the first one to the second one. So the average price will jump up here. All right. So it makes it easier for you to get into profitable territory. So you can be wrong and still be right. You can be wrong. Let's see, we're right here. We got in short and we're wrong, but the market's going to go up. We could still, if the market touches this one, we'll get in with 2 contracts, bring our average price up, and then all it has to do is just drop a little bit and we're back in profit again. Does that make sense? So if these markets just kind of roll through these little snaky patterns, you kind of try and get in at the top, and then you think, well, I think this is the top. And you can use, of course, there's tools, there's indicators, and there's things that we can use to help us better determine our entry points where we can be wrong and right and still be right. Okay. So that's kind of the name of the game of how you read these markets. So these little green dots right here are called the ATR, the average true range. And we're going to come in here, and I like to suck those in like 7. And so what you can do is you can 6 or 7. And so when it breaks, that would be one place where you'd maybe put your first contract in. And then if it didn't fall and make you money and it turned around and went back up, you'd wait for the next one to break. And that's where you'd put your second contract in. And then that would average your position, right? So we're just kind of randomly jumping in here to show you the example. And we'll see if we can't pull it out here with this one where we didn't wait for an arrow. So we want to wait for the arrow. We want to trade where the arrows are. So that's what you want to do. You want to get in right there. But if it goes up and gives you a down arrow and you go down, or if it goes up and gives you an up arrow and you go up and it goes down again, well, it's the next arrow you'd put in your second position. And then the third arrow you'd put in your third position. And that's going to bring your position down on the average. And then you're going to turn and eventually, hopefully, get that sneaky pattern going with you. And at some point you have to say, no, I'm going to pull the ripcord and I'm not going to do it anymore. I'm not going to go. And usually for me, that's 10 contracts. All right. 10 times you get to put some in, because that's one contract of the minis. And so then at that point you can say, well, I lost one contract of the mini. See that? Now we're in with 2 contracts, and look how close we are to the market. Whereas before we are clear down here, now we're way up here. All right. So now but we're short 2 contracts, which means if we keep losing money, we'll lose money more quickly. But if we start making money, well, now we're making money twice as fast as if we only had 1 contract. So it's kind of nice that it got us in with 2, right? So that's pretty nice. And then we can come in here and say, well, if it keeps going up, I could put in another one. So you come in and we'll say, I got 2 now. Then you can come in here and put 2 more up here. All right. And you can say, well, if it comes up here, and you look back in time, that's why it's got these lines across the screen. See that? That's lets you line it up with areas of resistance across the top, support across the bottom. Markets like to go up and test previous levels of resistance. So we'll put our next order up here for 2 more up here. And the reason we're going to put 2 on is because we got 2 now. So we're going to just want to equal it so it goes 50%. And we're going to put it right up there to the top, right up in there. All right. I like to put it just a hair closer because sometimes it likes to go up and test it, but not break through it. So if it doesn't break through it or touch it, then you don't get your order filled. It goes up there and then it flushes and you didn't get your fill. So now we're going to put it right here. And then we're just going to wait and see if it'll go up there. If it doesn't, if it starts to go down, well, we'll start making money. Nothing wrong with making money. All right. And that way you're not jumping in and out of the market all the time. Now, can you do this with the mini? Yeah, you can certainly do it with the mini, but you're going to have a much larger account and much bigger cojones. All right. Much bigger cojones. Because right now, if you were doing this with the other account, you'd be down $300 right now. Okay. Looking at a $300 loss right now. Right now, we're only $37. $37 just means you're not going to take your wife out to dinner tonight. $300 means you're not going to make the rent. Okay. So there's a difference. All right, look at this market go, man. It's cooking with gas. Okay, see if it'll touch it. Come on, touch it. Touch our order. See what happens. Oh, there we go. Now see it. Now we're in with 4 contracts, and it brought our order way up here, 50% between those 2 distances. Now we just need the market to fall, but it ain't falling. Come on, buddy. At some point, you're going to have to say, enough's enough. I'm going to lose too much money, so I'm not going to do it anymore. And again, for me, that's what I said, 10 contracts. We're only at 4 right now, so let's wait a second and see what happens. We'll go in here. We'll put our 4 in there. Now we're going to come to the next one up. Where's the next price they might test? Right here. I can see this. See this over here? Right there. So now if they go up there, now we'd be in with 8. That would be nasty. That'd be a nasty loss. We need it to turn and fall a little bit. That's a nice rally. Holy cow. We should have just taken a long position right here, huh? Rode that baby up. But we're showing you a different strategy. So all right, touch it, touch it. We want it to touch that order. We want it to fill it because then we'd have our order up there and then all we need is flush. We'd be in with 8 contracts to the downside. Now it'd be a pretty nice place to be short 8. All right, so you can get a pretty good sized position doing this strategy. Building it up. Oh, what happened? I don't want that. All right, come on. So we're down $35 right now. It's coming back for us. It's coming back. It almost, look how close we got. Look, see, if I'd have put that inside, like I said last time, we'd have got filled right there. Doggone it. I put it right at the exact price. We should have put it just a little bit inside like we did this one. And that would have been filled by now. If it would have got filled, this order would have been way up there. Looks like it's going to try again. It's going to touch it. There we go. Okay, now we're up here with 8 contracts. Now we're losing $130. See that? It's starting to get a little scary. We need the market to fall below our order. We're short right here. Anything below here is where we start making money. We're already at 8. Whew, this market's going like a crazy man. Took off like a rocket ship off of that order, didn't it? Off that little break down there. At some point, you got to say, enough is enough. Enough is enough. Because if we go in here and do 8, and put it. Oh, we got to go see what's over here. We're going to get heavy into this market. Look at this. Where's our next spots? Right there. Where'd my order go? Where'd my order go? Oh, I closed it. Okay, so we're right here. Right there's our next spot. We do 8 of them. Right there. That means we would do 14, 16 of them right here. So I'm getting heavy up in here, breaking my own rules, but we're going to try it. Okay. It's fun, isn't it? All right, we're having fun. We just need the market to go up there and touch that 8 and then drop like a rock. What if it doesn't drop, Lan? What if it just keeps going? Well, that's what I said. And this is a dangerous strategy because it can go against you pretty nasty. The market can stay irrational longer than you can stay liquid. We're down $500 now. See how fast you can make money with even with the micros. If we'd have been down here, of course, we'd have got in with 1 and ridden it up. But you could add on 1, 2, 3, 4, 5, get up. Away you go. We're just going to keep playing it. We're just going to keep going and see where it goes. But we're down with a $600 drawdown. That's nasty. I don't like that at all. Boy, the first time I show you the example, I get my hiney handed to me. Well, that's good for you to see, I guess. Makes you know that there's a danger zone in there. Now we're 32. Oh, my goodness sakes. That means we'd have to do 64. See, my numbers don't even go that high because I don't ever plan on going that high. 64. We should have bailed out by now. Where would the next one be? What I would do is if it comes down short 32, I'd take half those off. So we'd take about 7, maybe we'd take 15 of them off with a limit order down here, right there. Just enough to cover the commissions, just to take some of the pressure off. Come on, come down there and just take those off. And then you can go up some more. Come on. Touch it, touch it. You know you want to, you know you want to touch it. Oh, baby. Didn't quite touch it. Is it still going to go up some more? Where's our next level? Our next level is here. Oh, we already went to that one. That's it. That's the peak. So that's the peak right there. That was the highest point of the trend. Now it wants to go up and touch it. Come on, land. Just do it. Just do it. I don't want to do it. Because if it breaks that, it's likelihood to keep going, even after that big move. Come on, we just need it to come back down here just a little bit. Well, you're getting a good example of something going haywire on us. I just kept going in too fast. See, we're supposed to wait for an arrow. Follow your own rules, Lan. Come on. Man, this market's taken off. $32. I don't know if it'll let us do 32. There we go. There's a red bar. That's what we're looking for. That's what we're looking for. But Lan, if it takes off your 15 and drops on the way through, you'll miss the opportunity on taking 15 off. Yes, that's true. 15 down, 15 more, 32 contracts down. That's true. But it also lightens the load in case it just touches it and turns and goes back up again. When we're not quite so nervous. Come on, baby. Touch it. Touch it. touch our order. There we go. Now look, we're 17 short from up there. That's our average price. It's kind of weird. All right. So now we're up some monies. Short 17. We lost 337. That's how many we had to close out. We're up 400. We're going to go add OCO. So where do you want to take your profits? Let's take our profits if it'll just come down and test this low right here. Okay, if it'll come down here, take them off. Now we could take them off systematically too. We could come in here and say, I got 17, so I'm going to take 3 off here. And then I'm going to take 3 more off here, and I'm going to take 3 more off here. Come on, baby. We got our money back. Now we're up $700. Now we got the little green dot over there on the other side. That would be 6 out of the 14. So we could just come in here. You know what? We could just take 1 off until we get our money back, and then we play with the rest. Watch this. We'll do this little trick. We'll go, we're going to buy them back 1 at a time until we get back to the point that we've got our money back. There we go. We're up $47. I'm going to remove, that would take us off. Let's remove this one, and let's remove this one. And now we're just going to, see, I got all our money back. We're up $500. Now we don't know how low this market's going to go. It could just go to the way down, right? So what we can do is we can come in here and we got 8. We could say, I'm going to actually, right there's where I want to take 4 off. 3, 4. Okay, we're going to buy those off right there. Okay, so now we're up $321. Now we're going to come in here with, how many do we have left? 4, 3, 4, stop, drop that in here, edit, and we're going to trail this on the little blue dots, which is the little green dots, yellow dots. So it's the green dots, ATR. Where is it? Right there. Hit OK. Now it's just going to trail down. See how it's just going to follow down on that one little trail, just like that. And then you don't have to do anything. Everything else is taken care of for you. Okay. That was a little nerve-wracking there for a minute, wasn't it? Oh, we're going to get, good thing we took some of those off when we did. It's coming back against us. We don't want to get stopped out, but looks like we're going to get stopped out. Don't touch it. Don't touch it. We don't want it to touch this one. Don't touch it. Don't touch it. Oh, it touched it. So we ended up with what? $465. Ah, crap. That's about $35 shy of our $500 a day goal. That means we're going to have to do another trade. Not necessarily. It's close enough. I'm not going to, it's close enough for horseshoes. I don't want to risk my $400 to make another $50. So at this point, we're going to say we're good, right? Made our money. And it's 20 minutes before the market closes. All right, and this is just a quick example of what we're going to learn in our next class. So for those of you who are excited about our day trading class, we're going to learn a little bit about this day trading stuff. Plus, we're going to go into a lot more at the university for our day trading class, and we're going to learn about the indicators. We're going to learn about this ATR. We're going to learn what it is. We're going to learn about MACD, stochastics. We're going to learn about a bunch of other indicators as well, okay? So we're going to teach you all about the neat little indicators. We're going to teach about all these order styles. So if you liked all the different order styles I was using stop orders and limit orders. I was using buy market orders and sell market orders and exit chart orders. We were using OCO orders and trailing stop orders. We did a lot today. All right. So if you want to learn all that stuff, come and join me at the class. And then, of course, those of you who are not able to make it to the class, keep coming to the labs. and the labs will kind of try and help you understand it. But in the labs is where we actually put what we learn at the university to work. So we come in here and practice what we preach. So that's kind of what's going on here, coming up starting on Monday next week. So I'm very excited to teach that class at the university. And for those of you who are registered for that class, I'm looking forward to having you there. We're gonna have a lot of fun. And I'm going to come over here, and before we let you go for the day, I'm going to come and take a look at some of the questions, as John has a question. John's talking about something we talked about yesterday. Lan, yesterday class, you spoke about rolling out of the stock into or rebalancing your portfolio. Can this be done without creating a taxable event? No, it cannot be done without creating a taxable event. There are some things you could do, but you'd have to leave your money in there, because as soon as you sell it out, it becomes a taxable event. So to roll from one to the other, it's a taxable event. It's just the nature of the beast. So that's why oftentimes I'll say, once you buy them, you just own them forever. Just wait until they just give you all your money back, and then just pretend like it's not part of your portfolio anymore, even though it is. And it's going to keep giving you money. But the idea is that it's going to give you back all your money eventually, from the high yield plus ROC. You add those two together, and you're going to get all your money back. Maybe a year and a half, something. You're hanging on to this thing that you don't love. Of course, if it's a really bad one, like Moderna was, where it's just the yield can't keep up with the NAV loss. You just want to get out of that thing and take your lumps. I mean, sometimes that's just the nature of the beast. You have to take your lumps. So look, there's another trading opportunity right there. I want to take a short position. But if I'm wrong, I'd have to sit there and do the little dollar cost averaging all the way up again. So we've got 15 minutes till the market closes. Should we do it? I was going to let you guys go, but there's an opportunity right there to trade. Okay, we took it. And if it just goes, you're only in with one contract. And then you just kind of ride your little $6 trade down. But we're not going to put a stop. Stop would come in here and stop us out. Then that's how I trade when I trade the minis, because they're so big that you don't want to sit there and do this dollar cost average thing. You just stick it in there. And that's just the way it is. And if you're wrong, you're wrong. You get out. Take a tiny loss, because you could make it back on that one. This one, I mean, you could do the same thing, but this one gives you the opportunity to not be quite so. You don't have to be quite so right, because you could put your little limit order in here and take another one up in here. It depends on how aggressive you want to be. Like, well, looks like I'm wrong. Looks like I'm wrong again. Even though I'm wrong, you can still make money if it'll turn around and go back in our favor. So anyway, start the whole thing all over again and do it again. All right. So yeah, John, that's just the way that works. It's a taxable event. There's 15-minute bell. All right, guys, we're going to come in here. We'll watch that for a second, but I'm going to show you some fun little things here. This is the software I'm using.
Okay, this is the software I use. It's called Track and Trade. They've got two versions, one for stocks, one for futures. This is the website, track, the letter N, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right, so right now it's just kind of dilly-dallying around right there. And for those of you guys who are not aware...
Hey, Land Turner here. I got a hot stock market tip for you. Subscribe to Pitt News Magazine. You can thank me later.
Yeah, thank me later. Or thank me now. Pitt News Magazine just dropped not too long ago. Comes out at the first of every month, first Monday of every month. And so we're enjoying the current version of Pitt News Magazine. And there's a new version that we're working on. I got some really good stuff. Claire's got an article in there. And so be happy. And she didn't get it. I can't remember. Did she have an article in the last one? I think she did. But she's got an article that we're working on right now together. And so that'll be a fun article for you to read. Doc Brown's got an article. I haven't heard from him in a little while. He's pretty technical when he writes about stuff, but technical is good for a lot of people. They love that technical stuff. Claire goes through and simplifies it for you and tells you a little bit about why it was complicated. and then tells you how to understand it from a simpler point of view. So that's what's working with Pit News Magazine right now. So we're working on it, working hard, and got some exciting things for you to read in Pit News Magazine. And I'm looking forward to teaching our day trading class. See, we're only in the market with one contract, so we just got in with one. We didn't get the opportunity for it to go back and touch us and give us two short. If it just keeps falling, we'll just keep making money on a single contract. You can always add more, but we'll wait for it to drop a little bit first. $7. Better than nothing. Better than being wrong, right? Right? It's better than being wrong. How much money you have to have in here for each one of these contracts, Land? Go to the key. It'll tell you day margin, $171. That's all it takes to open up your account. You open up your account with a couple grand and come in here and do this. It's fun. Micro minis, day trading, small trades, small wins. Okay. That one got a little hairy. That was a big move. So we kind of got lucky on it. The fact that we stayed in there long enough to get it to come back against us or back for us. Here's another guy. Look at this funny guy.
Look, if you haven't subscribed to Pit News Magazine yet, then I'm going to need to see you professionally because you must have something wrong with your brain.
That's exactly right. For those of you who haven't subscribed to Pit News Magazine yet, you got something wrong with your brain. This guy wants to buy some. Look at this.
Yeah, of course. I have a lot of subscriptions for magazines. My most recent subscription, I picked up a lifetime subscription to Pit News Magazine as an example, among others as well. Yeah.
Yeah, among others. But, Pit News Magazine is the one he wants you to know about. We would never use AI to get celebrity endorsements, not here at Pit News Magazine. We would never do that. Never use AI for celebrity endorsements.
Yeah, when I heard Elon talking about Pit News Magazine, I called in and got a lifetime subscription, myself, of course.
Yeah, I don't know. I got a lifetime subscription. We don't even offer that. But for Bill Gates, hey, dude, man, he calls in, I'm going to give him a lifetime subscription. It's just $1 billion, Bill. All right, the market's starting to drop a little bit for us. We're up $8 already. We're not having a whole lot of luck here with any movement. Market's getting ready to close here in the 10-minute bell. Let's go ahead and delete that one. We'll just put a stop order in here and trail down on that little green dot, just like we did before. Drop it in here, edit, trail, ATR. And it's going to just trail down and get us out of when it crosses back above that little green dot that follows down behind the market. Depends on how far it drops. It's how much money you make. That's all there is to it. That's all there is to it. Once it gets to this point, you don't have any choice to do. The market's going to do what the market's going to do. You don't have anything other than just put your orders in there and sit on them. All right, well, we didn't make anything on that one. That one came back and stopped us out basically at break even. So we didn't have to stop out. We could have left our other one in there and let it go up and, do the dollar cost average thing. But we got the opportunity to drop that in there. We thought it might drop. So there it is. It is what it is. That's how you trade. Oh, look at it popping. Popping. All right, guys, we're going to go into this in greater detail. We're going to learn all kinds of fun little strategies and recurring price patterns and Fibonacci's and Elliott waves and accumulation distribution in our next week's class, starting next Monday. So if you have any questions, please let me know. And we're going to let you go for the day. It's great to see you here. And look forward to seeing you Monday in class at the university. We're going to have one more lab, probably let's do tomorrow morning at 8 a.m. All right. Tomorrow morning at 8 a.m., we'll have another lab, and then that'll give us Friday off to sit around in our underwear and enjoy the fact that we're getting big money coming in on Friday from our dividends. Okay, guys, we'll see you tomorrow morning, 8 a.m., bright and early.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pit News Magazine.
Oh yeah, definitely subscribe to Pit News Magazine. You'll thank us later.